Welcome back to another video. Today we got this is a good one today, ladies and gentlemen. I've been waiting to make this one. I did finally get a home. Don't have any lights here, don't have any of the camera equipment that I would have liked to bring, but let's get into this one. It is called What Your Student Loans Are Truly Costing You. So today I just wanted to talk about student loans, car loans, and what they're truly costing you, because we all know the obvious answer. The obvious answer is that you're paying some interest on those loans, right? That's the easy answer. But one answer that I really did not pay attention to is that your student loans and your car loans are blocking your path to wealth in another way, and we're gonna get into that right now. So let's talk about it. With the FHA, you're generally required to have a DTI of 43% or less, though it varies based on credit score. So to be specific, your front-end DTI, which is your mortgage payments only, should be 31% or less, and your back-end DTI, which is all monthly debt payments, should be 43% or less. So individual lenders may also have stricter requirements, but that's basically what it's costing you. It's costing you your ability to buy a home. We all know that everybody wants to buy a home, everybody wants to settle down, and many people out there, 8% according to the millionaire next door, want to become real estate investors. That is a great path to wealth. But anyways, what is it truly costing you? Let's get into some data from the Federal Reserve. In 2015, the average net worth of a homeowner was $195,400 compared to just $5,400 rather for a renter. So $5,400 for a renter compared to $195,400 for someone who owns a home. The significance is even more staggering for people of color. Wealth from home equity equates to 51% of the total wealth for the average white household and 71% for the average black household. Essentially, if you're part of America's fastest growing populations, it's likely that without a home, you don't have any wealth. So that's from the Federal Reserve themselves. So what does that tell me? That tells me that if you're unable to buy a home, it tells me two things. If you're unable to buy a home, you're very unlikely statistically to have wealth. Another shocking and sadder thing that it tells me is that people are not interested in buying businesses. People are not interested in their 401k. They're not interested in owning anything as far as their wealth outside of the home. So people are viewing their home basically as their biggest investment, which it can be a great investment depending on how you buy your home, what price you buy it for, and all these other things that are good to know. But people are basically just using their home as a forced savings account, and for the most part, that's what people are using as their retirement plan. They're using their home. So we got to change that culture, not just for white people, black people, just in general, right? We're here to make sure that we're getting interested in buying businesses and owning things that are going to pay us when we're old, because we can't work forever. So next thing I wanted to get into on the note of Federal Reserve is that homes and commodities appreciate when the Federal Reserve prints money to fund the government spending programs. So if you don't own a home, you don't own commodities, you don't own a business, your dollars are losing value and you're playing a losing game. So if you don't own anything, essentially what you're doing is you are subject to whatever the Federal Reserve wants to do with the value of the dollar. As the value of the dollar goes down, the value of your savings goes down. So unless you own something like gold or you own something like a home, you own businesses, places that own actual physical plants, your money is going down in value, because all the dollar is essentially a measuring stick that says how much of the real goods that you can get in the economy. So if you hold on to those dollars and more of them are printed, they're losing purchasing power. All right, next thing from the Bureau of Labor Statistics. The median wage for workers in the United States for the first quarter of 2020 was $957 per week, or $49,764 per year. This assumes 52 work weeks per year. Wages were 5.7% higher than last year. So what does that tell us? That tells us something that most people wouldn't assume, right? People think that they increased wages, but really, what really happened? Labor force participation went down, people stopped working, people are stuck at home, people are collecting unemployment checks. So what's really happening is a lot of jobs that are being cut of low-wage workers. This is because these companies ran out of money, a lot of them went bankrupt, and they had to cut their low-wage workers. So the low-wage worker is feeling this pandemic the most. So what happens when you raise the price of holding onto your low-wage workers, such as raising the minimum wage to $15? I'm not going to insert an answer there. But you can probably guess what's going to happen to those low-wage workers. The same thing that happened to them throughout this entire pandemic. They're disproportionately affected, disproportionately let go. 50K, that is the median salary in the US. So let's talk about this DTI. Back to this DTI. We're getting a little off track here. Monthly debts divided by gross income is how you calculate your DTI. So you got to take all your monthly debts for your back-end DTI, and you take just your mortgage for your front-end DTI. So based on the median salary, the front-end or just house payment DTI that the median person can afford in the US is $1,292. That's a $304,000 house with a 3% interest rate. Interest rates are pretty low. Based on that 50K salary, $1,792 is the back-end maximum. And right, you don't want to max out that DTI anyways, but 43% is $1,792 based off that 50K salary. So that's a $354,000 house with a 3% interest rate. So depending on whether you have debt or don't have debt, it's either $1,292 that you can afford or $1,792, depending on what your other debts are. But let's get into the next thing. So the average car payment is $523 new and $378 used. The average student loan payment is $393. On top of that, 47.5% of student loan balances are growing rather than shrinking. So if you take all of these factors and put them together, you've got 50K is the median salary. You've got $523 for your car payment. You've got $393 for your student loan payment, and that leaves $876 for your house payment. So that means that you can afford a house that is $200,700 at a 3% interest rate. This is assuming that you have pretty decent credit and you have to put down $40,000 for a down payment. So you have to not only pay your student loans, pay your car loan, you have to save up $40,000 and you can only afford $160,000 in loan essentially. So I'm hoping that this sheds some light on anybody out there who either doesn't have a student loan yet or they have a student loan and they're thinking about, going to buy a house. This is something that you have to consider. You can't just go buy a house. You can't qualify for a loan if you don't have the income to cover it. The banks are in the business of making money, so a lot of people out there think the banks are they are greedy. They're greedy. They don't want to lose money on you. And the way that they don't lose money on you is by not giving you a loan that they don't think you can pay back. So we need to know this stuff because we need to know that banks, they're in the business of making money, right? Banks aren't in the business of denying loans based on anything other than, can you pay it back? If you cannot pay it back, they're basically not going to give you that loan. So I don't know what type of house you guys can get out where you guys live for $200,000, but in Seattle, where I'm from, you can't get much at all for $200,000. You can maybe you can squeeze into a 2-bedroom condo for that, but good luck saving up the $40K if you're only making $50K a year. So hopefully that shed some light on this subject, and join the Facebook if you haven't already. I'll see you guys in the next video.